So, think about this for a second. You tap a button on your phone, right? And maybe 12 hours later, a cardboard box just magically appears on your doorstep.
Right. It feels like magic.
Yeah, exactly. But behind that frictionless digital experience is, well, it's this massive, incredibly heavy physical reality. I mean, we're talking millions of tons of concrete reinforced steel, just armies of trucks.
Yeah, and vast stretches of really highly optimized, incredibly expensive square footage.
Exactly. And welcome to today's deep dive where we are looking into exactly that.
It's essentially the physical internet. I mean, we rarely think about it until a supply chain breaks, but every single item you buy, consume, or use to build your house passes through this hidden infrastructure first.
Which brings us to our mission today. We are diving into the brand new Houston Industrial Distribution Market Report for Q2 2026. This is put together by the analysts at Lee& Associates.
It's a fantastic report, really detailed.
Yeah, it is. And our goal here is to decode the hidden backbone of our economy. So consider this your shortcut to being the smartest person in the room the next time supply chains or inflation comes up in conversation.
And Houston is, well, it's the perfect lens for this.
Yeah.
It operates as a massive global barometer.
Oh, for sure.
It's this critical logistics node where maritime shipping, rail, and trucking all converge. I mean, if you want to know what the broader economy is actually doing in mid-2026, you look at how many concrete boxes are being built in Texas.
Right, and how much people are willing to pay to put things inside them.
Exactly.
So let's jump in. The major takeaway from Mary Dettel, she's the research director over at Lee & Associates, is that this market is, quote, built for resilience.
Yeah, that's a great way to put it.
Right. She points out that we're transitioning out of that wild, panic-driven leasing spree we saw during the pandemic, and we're entering a more balanced phase of the cycle.
Yeah, and that word balanced it's doing a lot of heavy lifting in this report.
How so?
Well, for the last few years, industrial real estate was running at a dead sprint. Retailers were just hoarding warehouse space to guarantee they had inventory.
Oh, yeah, totally. The great toilet paper shortage we all remember.
Exactly, and that led to a historic construction boom. But, catching our breath from that sprint doesn't mean the market is collapsing.
Okay, well, let's test that idea of balance, because the first thing that jumped out at me in this Q2 data is, frankly, it's a massive contradiction.
Vacancy rates.
Yes. It feels like a pricing paradox. Direct vacancy in Houston's industrial market actually went up in the second quarter. It's sitting at 6.4%, which is up from 6.2%.
That's right. So more empty space is currently available for lease than we saw at the start of the year.
But then the citywide average asking rate for rent just hit a brand new cyclical high.
Yeah, it did.
Landlords are currently asking for about 79 cents per square foot, which is up from 67 cents in the previous quarter. So on behalf of everyone listening, wait a minute.
I know it sounds counterintuitive.
Right. Supply goes up, meaning more empty buildings, but prices also go up. I mean, Economics 101 says you slash prices to get tenants in the door.
You'd certainly think so if you were looking at a static market. But you have to look at the mechanism behind that 6.4% vacancy rate.
Okay, what's the mechanism?
Well, in the second quarter alone, developers delivered roughly 6.4 million square feet of brand new speculative space to the Houston market.
Speculative meaning they poured the concrete and built the walls before a single tenant actually signed a lease.
Exactly. They are betting millions of dollars that the demand will be there when the doors open.
Wow, okay.
And when 6.4 million square feet of space hits the market all at once, I mean, it doesn't get leased on day one. It takes months for companies to tour the spaces, negotiate these complex leases, and move in.
Right.
The report calls this the normal lease-up process. It's just the mechanical reality of delivering massive industrial parks.
So it's basically like imagine a city opening 3 brand new ultra-luxury hotels on the exact same weekend.
That's a great analogy.
Right, because on opening day, the city's overall hotel vacancy rate technically spikes because there are thousands of new empty beds.
Right.
But because those rooms are premium, the owners aren't going to panic and drop the room rate to $50 just to get bodies and beds on week 1.
Exactly. They're going to hold their nerve and charge top dollar, knowing it might take, 6 months to reach capacity.
Okay, so that captures the landlord's mindset perfectly right now. They have immense pricing power, specifically for what we call Class A distribution assets.
Yes, Class A is the key term there.
But wait, what actually makes a warehouse Class A? Because, I mean, from the highway, they all just look like giant gray rectangles.
Yeah, they really do. But it comes down to the operational math of the building inside.
Like what?
Well, a Class A facility might have 36 to 40-foot clear heights inside,
Yeah.
allowing a tenant to stack racking systems much higher.
Ah, so they get more volumetric storage for the same floor space.
Precisely. Plus, the concrete floors are thicker and flatter to support heavy robotics.
Oh,
And the truck courts outside are wider, maybe 180 feet, which allows those modern 18-wheelers to maneuver easily without bottlenecking.
I see.
So if a major logistics company wants that level of hyper-efficiency, they have to pay for it. The landlord knows this, so they hold firm at 79 cents a foot.
They'd rather let the building sit empty for 4 months to secure a 10-year lease at a premium rate than lock in a discount just to fill it fast?
That is exactly what's happening.
Okay, well, if landlords are successfully holding out for record high rents, my immediate assumption is that developers must be foaming at the mouth. I mean, if I can charge 79 cents a foot, I want to build as many of these Class A boxes as humanly possible.
And that brings us to the second major shift in this report. Developers are doing the exact opposite.
Wait, really?
Yeah, they're pulling back aggressively,
Okay, let's look at the pipeline numbers for a second because the total amount of space currently under construction dropped to 15.8 million square feet.
which is down from 16.6 million in Q1.
Right. And new construction starts, meaning developers actually breaking ground and pouring new foundations, that plummeted down to 5 million square feet.
It is a massive deceleration in building. But to understand why, we have to look at the one metric in the development pipeline that actually went up.
The pre-leasing rate.
Yes. The pre-leasing rate on those new construction projects jumped from 12.6% up to 18%.
So developers are holding off on the bulldozers until they have nearly a fifth of the building officially rented out on paper.
Exactly.
Let's break down the mechanism here. Why the sudden caution? If the tenant demand is clearly there to support high rents, why is the developer suddenly afraid to build on speculation?
It all comes down to the cost of capital in 2026.
Interest rates?
Yep. Developers don't typically build these 500,000 square foot facilities with cash, right? They use massive construction loans.
Sure.
So a few years ago, when interest rates were sitting at rock bottom, developers carrying costs on an empty building were incredibly low. You could afford to build a giant box on spec and just wait for a tenant to show up.
Because the monthly interest payment to the bank wasn't bleeding you dry?
Right. But today, financing costs are significantly higher and construction materials are more expensive.
Right. Inflation hits everyone.
Exactly. So if you borrow $50 million to build an industrial park today, your monthly interest payments are staggering. You cannot afford to let that building sit empty for a year.
So the financial risk of speculative building has simply become too high.
Yep. By demanding that 18% of the building is pre-leased, the developer is essentially forcing the tenant to share the risk before the first shovel hits the dirt.
Okay, and from the tenant's perspective, signing a lease for a building that is currently just an empty dirt lot shows incredible strategic confidence.
It really does.
I mean, they're making a calculated multi-year bet on their own revenue growth before the walls even go up.
It's a remarkable sign of health in the broader economy. And we also have to contextualize just how much concrete Houston has poured recently.
Right. The report notes that the market has added 185 million square feet of new industrial inventory just since 2018.
Which is mind-boggling.
185 million square feet. I mean, that is the equivalent of taking the entire footprint of a mid-sized American city and just paving it over with flat white roofs.
Yeah, so when you add that much capacity to a system in just 8 years, a deceleration isn't a red flag at all. It's actually a feature of a mature market.
That makes a lot of sense.
If developers kept building at the 2021 pace with 2026 interest rates, we would be facing a massive oversupply crisis. Instead, the market is self-regulating.
Right. Supply is finally aligning tightly with actual tenant demand.
Exactly.
Now, if developers are being this hyper-disciplined about whether they build, it completely changes what they decide to build, because they aren't just stamping out identical boxes anymore.
Not at all.
The report breaks the entire Houston market down into 3 distinct architectural categories. We've got rear load, front load, and cross-dock facilities.
And the physical layout of these buildings dictates the underlying economics of the supply chain.
Let's start with rear load facilities. These represent the smallest average deal size in the entire report, coming in at about 32,000 square feet.
Right.
But they command the absolute highest rent in the market at 86 cents per square foot. Smallest footprint, most expensive rent. Why?
Proximity. Rear load facilities are the engines of last-mile logistics.
Okay, last mile meaning.
These are older or really specialized buildings located deep inside the city limits, nestled right up against dense residential neighborhoods.
Oh, I see.
Think about the logistics of delivering a package to your door in 2 hours. You cannot dispatch that delivery van from a mega warehouse 30 miles outside the city. It has to be staged in your backyard.
Right.
But land inside the city limits is incredibly scarce and wildly expensive.
So it's basically the high-margin convenience store model. The building is small, it's right around the corner from your house, and you, the tenant, pay an absolute premium for the geographic convenience.
That is the exact mechanism. You are paying for the geography, not the architecture.
Makes sense.
Now, front-load facilities sit in the middle of the spectrum, averaging about 70,000 square feet and pricing around 79 cents.
Okay.
But the real contrast to the rear load is the cross-dock facility.
Yeah, let's talk about those. The report shows cross-docks are absolute behemoths. I mean, the average lease size is nearly 160,000 square feet, but they have the lowest price per square foot at 68 cents.
Right.
What makes a cross-dock so fundamentally different?
Well, the clue is in the name. A cross-dock facility literally has dock doors running down both sides of the building.
Okay, so it's not just one loading bay.
No, it's not designed primarily for long-term storage at all.
Mm-hmm.
It's designed for massive high-speed throughput.
Give me an example of how that works.
Sure. Imagine an 18-wheeler arriving from the port, full of imported electronics. It docks on the east side of the building and unloads.
Okay.
Those pallets are immediately broken down, sorted right in the middle of the warehouse, and then driven straight onto a fleet of regional delivery trucks idling on the west side of the building.
Wow, okay.
The inventory literally just crosses the dock.
So it's the massive Costco out by the highway. It's built for sheer volume and rapid turnover at a lower unit cost. But why is the rent so much cheaper per square foot?
Because of the land requirements. To operate a building with truck doors on both sides, you need enormous concrete aprons for heavy trailer circulation, turning radii and, idle parking.
Right. Can't squeeze that into a downtown block.
Exactly. You simply cannot find that much available land inside a dense city center. You have to build cross docks further out on the geographical fringes of the city, near major highway interchanges where land is relatively cheap.
Which perfectly explains the geography of Houston submarkets in the Q2 data. I mean, the Southwest submarket, which has a lot of that newer infill last-mile inventory.
Right, the rear load stuff.
Exactly. It has the highest asking rate in the city at 86 cents. Meanwhile, the Northeast submarket is out on the periphery and is incredibly competitive at 63 cents.
And if you want to know where the sheer volume of logistics activity is actually happening, look at the Northwest, South, and Southeast submarkets.
Yeah, I saw that. Those three areas accounted for nearly 60% of all leasing volume in the second quarter.
It's a huge concentration.
So let's connect the dots there for the listener. Why are tenants flocking to the South and Southeast specifically? What's driving 60% of the leasing volume into those pockets?
Two things, really. Massive population expansion pushing outwards, and critically, proximity to the Port of Houston.
Ah, and there is the macro engine, because all of this highly optimized real estate, these neighborhood convenience stores and highway Costcos, it doesn't exist in a vacuum.
No, it definitely doesn't.
You don't build a 160,000 square foot cross dock unless you have an absolute torrent of goods flooding into the region to fill it.
And the Port of Houston is the beating heart of this entire industrial ecosystem. The numbers here are just staggering. In May of 2026, the port handled roughly 398,000 TEUs.
Okay, let's define that quickly for you guys listening. TEU stands for 20-foot equivalent unit. It's the standard metric for those corrugated steel shipping containers you see stacked on cargo ships. So nearly 400,000 of those steel boxes move through Houston in a single month.
Exactly, and that represents a 4% increase year over year.
Wow.
But what is particularly fascinating right now is the balance of that trade. Despite shifting global trade routes, rising tariffs, and just general geopolitical friction, export activity out of Houston remains incredibly resilient.
That's interesting.
Yeah, we aren't just absorbing goods from overseas. We are manufacturing and refining materials and pushing a massive volume of goods back out into the global market.
Which really shatters a pretty common misconception. I think a lot of people outside of Texas still view Houston as just an oil town. A place
Right.
whose entire economy rises and falls on the price of a barrel of crude.
I mean, the energy sector is obviously still a massive baseline for the region. West Texas Intermediate crude was sitting at around $85 a barrel in June 2026, and we still have roughly 580 active drilling rigs out there.
Which generates an enormous amount of foundational capital.
Yes, but the employment data in this Lee and Associates report tells a much more complex story about how the local economy is actually evolving.
Yeah, the overall numbers are strong. Houston has 3.5 million jobs right now. The unemployment rate is at 4.6%, which is just a hair higher than the national average of 4.3%.
But the internal shift in where people are working is the real story here.
Walk us through that sector breakdown.
So manufacturing jobs actually dropped by 1.2% year over year. Mining and logging, which includes a huge portion of the oil and gas field services sector, dropped sharply by 6.4%.
Wow, 6.4%.
If this were the Houston of the 1980s, a 6% drop in energy jobs would trigger a local recession.
But instead, we see construction jobs up by 3.5% over the same period.
Exactly.
We're watching a literal real-time shift in the labor force.
Right.
The economy is moving away from just extracting things from the ground and shifting toward building the massive infrastructure required to move global goods.
It's true. The logistics gateway is absorbing the blow from the softening energy sector.
That is the definition of a diversified, resilient economy.
It really is. The trade volumes at the port and the boom in infrastructure construction are acting as massive shock absorbers. They are holding the entire region steady, even while national inflation lingers around 4.2%.
And the smartest, most risk-averse money in the global financial system is watching this exact dynamic play out, and they are buying in.
Oh, absolutely.
Let's talk about the institutional investment data.
This is perhaps the ultimate leading economic indicator in the report. Institutional buyers, we're talking about massive pension funds, life insurance companies, sovereign wealth funds, and private equity groups.
The big money.
The biggest money. And they are still heavily targeting Houston industrial real estate. In the second quarter, the average sale price for these properties rebounded up to $151 per square foot.
Okay, I want to make sure you, the listener, understand the sheer scale of the bets being placed here. When a life insurance company pays $151 a square foot for a 1 million square foot logistics park, they are writing a $151 million check for a concrete box.
That's right.
Why? I mean, what makes a warehouse such an attractive asset for a pension fund that needs to pay out retirees in 20 years?
It comes down to yield and stability. An institutional investor doesn't care about the concrete. They care about the cash flow.
Okay.
They look at Houston's population growth. They look at the 400,000 shipping containers moving through the port. And they look at the diversification of the job market.
They realize that people are never going to stop ordering goods.
Precisely.
Mm-hmm.
And supply chains will always need a physical hub in the Sunbelt.
So they view that warehouse as a nearly bulletproof 30-year bond. Every time you click buy on your phone, every time a local contractor buys lumber to build a new neighborhood, you are generating the tenant demand that pays the rent on that concrete box.
All connected.
The institutional investors are essentially betting billions of dollars that the Houston logistics engine is a permanent appreciating fixture of the global economy.
It is a massive vote of confidence. Wall Street does not deploy billions of dollars into a real estate market unless they believe the 10, 20, and 30-year macroeconomic trajectory is incredibly secure.
Well, we've unpacked a lot of complex mechanics today, so let's pull all these threads together. Looking at the Q2 2026 report, the Houston industrial market is giving us a masterclass in economic balance.
It really is.
We've got this fascinating pricing paradox where landlords have the power to push rents to cyclical highs even as vacancy ticks up because they know the value of premium Class A space.
Yep. Yeah.
We have developers who have sobered up from the pandemic frenzy. They're dealing with expensive capital by demanding high pre-leasing and pulling back on speculative builds.
Exactly.
We mapped out how the architecture of a warehouse, whether it's a tiny, expensive rear load in a neighborhood or a massive, cheap cross-dock on the highway, dictates its role in the supply chain.
Right.
And fueling all of this is a sprawling, diversified macro economy anchored by a thriving port and backed by billions in institutional capital.
It paints a picture of a sector that has really grown up. The wild, unpredictable swings of the early 2020s have stabilized into a highly efficient, heavily calculated logistics machine.
But before we wrap up, I want to leave you with one final thought to mull over. It's something that wasn't explicitly modeled in the data, but the report practically points a massive neon arrow at it.
Yeah, this is the really interesting part.
The Lee and Associates analysts noted that tenants right now are prioritizing operational efficiency over expansion. Companies don't necessarily want more square footage. They want the space they already lease to work vastly harder for them.
Which is where the physical world collides with the digital world all over again.
Exactly. Because we are on the cusp of advanced artificial intelligence and high-speed robotics becoming fully integrated into these spaces.
It's happening right now.
So the question becomes, will the warehouse of the future even look like a massive 500,000 square foot box used for storing pallets of goods just in case someone buys them?
I mean, if predictive AI can analyze consumer data and know exactly what a neighborhood is going to order 3 days before they actually click buy, the need to physically store massive amounts of excess inventory drops dramatically.
Right. What happens if these facilities evolve from passive storage boxes into smaller, infinitely smarter, high-speed sorting machines?
That's the paradigm shift.
The physical footprint of global trade might actually begin to shrink, even as the volume of goods being shipped skyrockets.
It's wild to think about.
What happens to the landscape of our cities and the billion-dollar investments of those pension funds when logistics suddenly values digital brainpower over physical square footage?
It's the multi-billion-dollar paradox for the next decade. Real estate is fundamentally about maximizing the value of space, but technology is increasingly about eliminating the need for space altogether. It's a fantastic question to keep an eye on.
The physical infrastructure moving our lives might eventually get smaller, but the thinking behind it is only getting bigger. Thank you for joining us on this deep dive into the hidden backbone of the 2026 economy. Keep your eyes open the next time you drive past one of those quiet giants off the highway, and until next time, keep looking behind the click.